All right, and the last thing we're going to be doing today is finishing off those journal entries that we call adjusting entries. Learning objective 2 focused on what we call or classify as deferrals. Learning objective 3 looks at what we call the accruals, okay? Again, both a balance sheet account and an income statement account are going to be affected just like you saw, okay? So accruals, we want to make sure we're counting the revenue for this month, even though we might not collect it until later. And we're also recognizing the expenses for the month, even though we might not have paid them yet. So we'll pay them later. Okay. But again, we're doing these adjusting entries because the very first statement that we do is the income statement, which means all the revenue has to be there and all the expenses have to be there to make sure that that statement is correct. And as you know, from that statement, that net income flows to the other statements. And so we have to make sure the income statement accounts are correct when we do our income statement. So again, it might be a little bit of a pain, but it's just simply double checking. All right, so there are three entries that you're going to be learning here. One accrued revenue and two accrued expenses. So it'll be a little bit more brief than the previous objective. So again, an accrued revenue, revenue that you've actually earned, but you haven't received the cash yet, and you haven't put it down in the record yet. It hasn't been recorded in the journal yet. So you have to make sure you do that. And so this adjusting entry is simply indicating whether we have all the revenues for that period of time in our revenue account. And if we don't, we have to put them in and set up a receivable. If we haven't received the cash now, we will receive the cash in the future, which is simply a receivable. Okay. And so we're going to be focusing in on basically services that we've performed, but haven't gotten paid yet. Let's take a look at how this works. So for an accrued revenue, we want to make sure we have the revenue recorded and part of our income statement. So we're going to credit the revenue account. But because we're not going to be collecting that money until later, it's going to affect an asset account. We know this is going to be accounts receivable, okay? Because that's how we say we are going to wait to receive cash later. So here we go, illustration. This is the fifth entry, adjusting entry that you're learning. There's only 7. This is the 5th one, okay? And the only one with accrued revenue. So Sierra Corporation performed guided services for $200 that have not been billed yet on October the 31st. So if it happened on October the 31st, then this revenue needs to be on the income statement for October. That's basically the bottom line. This revenue has to be part of the income statement in October. Well, we haven't billed them yet. So now we have to do an adjusting entry to make sure the revenue is there. And the adjusting entry would simply be setting up an accounts receivable for that $200 so we can bill the client, and making sure that $200 is in our revenue in October when it happened. In October when it happened. And that's basically all we're doing here. So the adjusting entry would give us a balance for accounts receivable, and we would have an adjusted balance for service revenue because that $200 would have to be added in. Okay. If we didn't, look at what happened here. If we didn't do any adjusting entries, the revenue for October would only be listed at $10,000. But because we are checking and double checking, right, we now have revenue of $10,600. Now that's better because the more revenue there is, the more profit there's going to be. It's also more accurate, more truthful, more faithful represented. So this is very important why we have to do all of this stuff. Okay. And the very last 2 you're going to be learning are what we call accrued expenses. An accrued expense is an expense that you want to recognize in the period that it happened, because that's really how it happened. But you're not going to pay it yet. You're not going to pay the bill yet. You'll pay it a little bit later. It happens pretty often with a lot of different things. We're only going to be focused on two. The amount of interest that we can expense on certain notes payable. Remember, we don't actually pay the interest on notes payable until we pay the note back, because that's how notes payable work, right? But that doesn't mean that interest isn't piling up every day. So we're going to want to expense the interest in the month that the interest occurred, but we're going to say we're going to pay that later. Okay. The same is true with salaries, right? You might be working in the month of October, but your payday is not until November. So you have to expense those salaries in October, even though you're not going to pay those employees until November, which is the next payday. And this is basically the two that this book focuses on. So one at a time. Okay. So when we actually do an accrued expense, we're going to be doing two things. We're going to be taking the expense, which means we're going to debit the expense account. But we're also going to set up basically a payable, a liability, to say and to show that even though we expensed it, we're going to pay it later. We haven't paid it yet. We'll pay it later. So this is an accrued expense. And again, we're only doing two. The first one is interest. Now, again, back in October, Sierra Corporation had this note payable for 3 months. So for the month of October, how much was the interest? Okay. Well, this is the formula. Okay. Give me the formula, Krebs. Okay, here it is. We have a $5,000 loan note. 12% is the annual rate. In other words, 12% is for all 12 months, annual rate. We multiply that by the annual rate. But now we also have to multiply that by the time. We're only looking at 1 month of those 12 months, the month of October. So the amount of the loan times the annual rate times the time, which is just 1 month of the 12 months, means that $50 of interest has happened for the month of October on this loan. So this $50 of interest literally is an interest expense for October. And that's all we're doing. Of course, we're not paying this until we pay back the loan 3 months from October 1st. So we can't say that, or we have to set up what we call an interest payable, as you'll see. So the entry here shows for the month of October, this loan cost us $50. And so $50 interest expense for October is truly what happened. That's the cost of that loan for October. We're not paying it yet. We're paying it when we pay the loan. So we set up an interest payable. Interest payable will go with that note payable. We'll pay all of it when it's due. Okay. And this is how the journal looks when it gets posted into the ledger. We now have an interest expense for the first time for this month. And we also have interest payable for the first time, because that's what happened here. This is the 6th of the 7 adjusting entries you need to learn. Okay. And again, we're only, in this case, it's only for the month of October, which is why we are multiplying it by 1 month over 12. This is an annual rate. It's not 12% per month. Okay, you get a better loan from the mafia. But I think that in essence, this is just an annual rate. So we're looking at 1 month of the 12. Okay, and that's why we have to multiply it by the time factor here. And the very last one is what we call salaries, accrued salaries. And this happens all the time because, as you know, a lot of people get paid weekly or biweekly. So here is the month of October for Sierra Corporation. Their very last payday in October is the 26th, Friday the 26th. And that means that that particular payday will be for the 2-week period that you see here. Okay. So October still goes on after the 26th, right? And this company is only working a 5-day work week. Okay. So you have Monday, Tuesday, and Wednesday in October 29, 30, and 31, that is work in the month of October, but will not be paid until the month of November during the next pay date 2 weeks later. Well, these 3 days of work are October expenses, although you're not going to pay them until November. So again, they have a $2,000 a week payroll, which is basically $400 for every day of the week, 5 days a week. These 3 days happen in October. So if 3 days of payroll happen in October, but you're not going to pay them until November, you have to take the expense in October for this $1,200 for salaries and wages. And that's all this is about. So the last one, the 7th adjusting entry that you're learning of the 7 is an accrued salary. You are going to expense those 3 days of work in October because they happened in October. And so we have a salaries and wages expense for $1,200. We're setting up a salaries and wages payable for $1,200 because we will be paying that, on, I think the calendar said November the 9th, but still, we're doing this as of October 31st. So it becomes a payable. So that's the journal entry. Once this gets posted into the ledger, you will see now the balance in salaries and wages payable has been adjusted up to include that $1,200 expense for October. And salaries and wages payable has been adjusted as well to show they're going to be paying that in the next round. So let's take a look at how this would be in the do it exercise. If you have your book handy, then you want to turn to page 170. This is on page 170. Do it exercise. And it just shows you the 3 accrual entries that we just learned. Okay. And so this is the company Micro Computer Services. It began operations October the 1st, and now we're at the very end of October, and management is trying to put together their monthly income statement first, obviously. So these 3 things should be noted. Number 1 is at the end of October, there was $800 owed to salaries for employees. Number 2, the company had a loan from a bank, a mortgage, with an annual rate of 10%. We're only worried about August in this case. Right. And the third thing that happened is they actually performed $1,100 of services, but they didn't record it in August, and they need to. So the 3 adjusting entries here is what we have to do. So again, if you owe, in this case, this particular company has a payroll in September, but the employees worked in August. So they want to make sure that $800 is part of a salaries and wages expense in August. And so here they basically set up a salaries and wages expense in August. It should be a date here, August 31st, with showing that they're going to be paying that soon in September, in this case, very next day. But anyway, doesn't matter. On August 31st, it's a payable. This is always a tricky one when you get to the loans, because people start looking at, okay, it's 30,000, 15 years. We don't care about that. All we're doing is what interest is subject to an expense in August, that 1 month. That's it. We're not looking at the 15-year period. We're only looking at what's happening at the end of August for that month. So 1 month of this loan, $30,000 times 10%, which is an annual rate, times 1/12, 1 month of the 12 months, will give you the interest that you need to know, which in this case is $250. Again, you would have the date here in the journal, interest expense of $250, interest payable set up for $250. $250 is the specific interest for August of this loan. Okay. That's usually the toughest one. And the last one is they performed services. They just forgot to record them in August. So this revenue was done in August, and so it should be on the August income statement as revenue. So for August 31st, you're simply going to set up, and again, the date is missing, but it should be there. They should set up a receivable for $1,100 to make sure that that revenue is in August, so it shows up on the August income statement. That's the goal. That's it. So we've just learned about 7 different adjusting entries in the journal. Those are the only 7 you have to know for this particular class and this particular book. There are many more, but that's okay. You don't have to worry about that. You only have to worry about the 7 that are in the book. 4 of them are deferrals, 3 of them are accruals, and they always affect an income statement account and a balance sheet account, every single one. And the pairs, you can memorize them. You're going to memorize these pairs if you really wanted to. Supplies, expense, and supplies. Insurance expense and prepaid insurance. Depreciation expense and accumulated depreciation for equipment. Unearned service revenue and service revenue. Those are your deferrals. Your accruals, accounts receivable and service revenue. Interest payable, interest expense and interest payable. Salaries and wages expense and salaries and wages payable. So that's the set of 7 that we're worried about. That's the only 7 that is talked about, and they repeat. They're always the same pairs in the adjusting process. Okay. And again, we're adjusting them to make sure our income statement is accurate. In order for the income statement to be accurate for the month or for the year, all the revenue has to be there and all the expenses have to be there. And this process helps us double check to make sure all the revenue is indeed there, all the expenses are accounted for, and so our numbers will be good.